Hey guys, welcome back to the channel. So today I want to discuss a recent interview on the Meet Kevin podcast where Kevin asked Peter if he would invest in Tesla and Peter Schiff gave his response. Peter is a longtime bear. He sees US equities as extremely overvalued, so it's not surprising that he looks at Tesla this way. However, I want to analyze his response, and as a Tesla investor, I obviously disagree with it. And I want to bring some data and reasoning why this is and really what Peter and Wall Street as a whole is missing regarding Tesla. However, before we start, if you can please like and subscribe in order to support the channel. Now let's get into the video and I will interject in between.
Is Peter Schiff going to be selling us on Tesla stock?
On Tesla?
Yeah.
I mean, look, Tesla, if at some point in the future, Tesla is cheap and it pays a good dividend, I mean, I may be looking at buying it.
Okay, so the first point Peter makes is that he would invest in Tesla potentially if they paid a good dividend. And this is where I would say you have to differentiate between different investment strategies. So if you're looking to invest in dividend stocks, then of course, this is what you would wait for. But I believe most people are investing in Tesla on growth. So now let's actually look at some examples of why some portfolios would be focused on dividend and why some might be more focused on growth. So if we look here, this is a $10 million portfolio, and Peter Schiff, he's a very wealthy individual, and many of the investors investing in his funds are looking to preserve capital because of his focus on gold and value and not growth. So if we have this $10 million baseline, we take out 10 years of growth with a 2% dividend. You'll see why I took 2% after. We compound it 4 times annually because usually dividends are paid out quarterly. We end up getting to a bit over 12,200,000. So in the 10 years, you went from the 10 million to over 12,200,000. And this is someone who is looking to preserve their capital, and they can also throughout this period live on those profits. And here they have the ability because they already have that $10 million and they tacked on over $2 million on top of that in just 10 years. So maybe a portfolio with $10 million focusing on dividend stocks is definitely a great strategy. Now let's look at a much smaller portfolio, although a substantial sum, and we'll see how the dividend strategy plays out here. So if we look at this portfolio, it's $100,000. We take the same 10 years, a 2% yield, and we compound it 4 times annually. We end up with $122,000. So this is at $22,000 in profits, and there's obviously not a sum that you can live off, and it took 10 years to get to that. So when you look at already this portfolio, you think, okay, do I want to take the dividend approach or do I want to look for more of a growth approach to my portfolio or diversify it between growth and dividend? Now let's look at an even smaller portfolio. So if we see here 10,000, the same 10 years, 2%, 4 times annually, we end up with $12,207. So you end up with $2,000 in this case, obviously not life-changing and obviously not livable from this. So from here again, you come to the conclusion, do you want to take the growth method or the dividend method? Now you can definitely look for dividend growth, but the fact is you're still not just looking at that dividend, which we see in the video that's what Peter Schiff's focus was on. If we contrast that and you're really just looking for growth, then we can look at 2 different scenarios. So one is, for example, taking a Tesla and saying, I'm going to invest in it and make 10x. Obviously, you have to do your due diligence. You have to really understand the company. You have to understand what people are missing because that's why it's not reflected in the stock price. And then from there, you're looking for 10, 20x over a 5-10 year period and sometimes even more. Or you can really go even the easier method and you invest in an ETF, for example, tracking the NASDAQ, which is very tech heavy. And in 10 years, you made 500%. So you 5x'd your money. So instead of a portfolio that was 10,000 becoming 12,000, it's 10,000 becoming 50,000 or 100,000 becoming 500,000. And this is taking the more diversified approach. The point is, it really depends on what strategy you're taking. But clearly, Tesla stock is definitely not part of Peter Schiff's.
I mean, everybody's making electric cars. See, the problem is Tesla moves first, right? And they make these cars and everybody wants to buy them and they start making some money. But then when you're successful in capitalism, you create competition. And investors tend to forget about that. They just assume that the leads you have, you're always going to have it. But you don't have it because the minute you start making money, you're sending a signal. And there's a lot of car companies all around the world with pretty smart engineers. It's not like Tesla's got a monopoly on these guys. And they see, oh, Tesla's making a bunch of money selling electric cars. We want to sell electric cars. We want some of that money.
I agree with him in the sense that, yes, capitalism does bring competition, but I disagree with him in the fact that Tesla, yes, is a monopoly when it comes to making profitable electric vehicles that actually match and are better than internal combustion engines. And I think this is here to stay because I think they forget that there's a difference between radical and incremental innovation. Incremental innovation is when you innovate something that is just a bit better or a bit different than the product that's before. Radical innovation is when you radically change a product that it's a new product. And yes, the vehicle looks the same, but electric vehicle and an internal combustion engine are totally different things. And it took Tesla 15 years of being the only one in the market, which meant that they were able to get investments because that was the only place to invest in electric vehicles, and work their way through all the hardships to ultimately come out on top with the Model 3 and then now the Model Y. Now they're an extremely cash flow positive and profitable beast of a company. But all the other automakers, first of all, the new ones that are coming in, if investors see that they're not actually hitting on their targets, who says that they won't take their money out and put it in, say, Tesla, a company that's already profitable? You didn't have that ability back then. And all the other automakers, they're going to be winding down their ICE vehicle sales, which is going to be damaging their company and ultimately stealing market share from their ICE vehicles while they ramp up their electric vehicles, which again, it's a radical innovation. So sorry, it looks the same, but it's extremely difficult to just transition over.
We don't, we own, I think, one auto stock in our portfolios, a European auto company.
What is it? GGPI?
Daimler.
So he says that he does own an auto stock, and that's Daimler. And I'm going to show some data, and this really will portray why I'm invested in Tesla stock and not Daimler. And you can take from this data what strategy works best for you. So if we first look at the chart of Daimler going back 22 years, we can see that it's pretty much, you could have been up on Daimler or down on Daimler. It looks pretty flattish with its obvious peaks and troughs. And this is why I used the 2% dividend before, because this is their dividend. And this is really what Peter is more focused on. Now let's actually compare the numbers between Daimler and Tesla to see if Tesla is really overvalued and Daimler is the better pick. So first of all, the market cap of Daimler is about 90 billion, while Tesla is 900 billion. So Tesla is 10 times bigger, and then we have to see, is this justified? So when it comes to sales, Daimler delivered 2.84 million vehicles, while Tesla did 936,000. So Daimler did about 3 times more. The revenue also was about 3 times more, which was 176 billion versus the Tesla's 53. And when it comes to EBIT, which is earnings before interest and taxes, Daimler did 7.5 billion, while Tesla did 6.5 billion. So Tesla was only 1 billion behind Daimler when their vehicle deliveries and revenue was 3 times smaller. Which means technically if Tesla delivered the same amount of vehicles, then their earnings would be 3 times bigger, which is close to $20 billion. However, what I would say is that it would be much more than this because Tesla doesn't have economies of scale yet. As you deliver more vehicles, you end up having better margins because the factories and employees, they stay the same. Moreover, we know that Daimler has been a company that's been around since 1926 and they are done growing. They're kind of reached max capacity. They are what they are, and this is what they make. They're a premium automaker, and it's not like they're suddenly going to be delivering 10 million vehicles. Tesla actually has a very good chance of doing this because as we transition to electric vehicles, they're the ones with the most market share. And remember, like we said, this is a radical innovation, so it's likely to stay this way. Meaning that if they get to that 10 million mark, and Elon says 20 million, but even the 10 million, because that's where Toyota and Volkswagen are about, then we are talking about an auto company that has margins that have never been seen before because Tesla already has the highest margins, and that's without the economies of scale. So already here we see that it's justified that they're valued a lot more because remember, investing is about the future, and clearly individuals see Tesla as that leader in the future. Additionally, there's no reason we're still having that conversation that Tesla is just an auto company. If we look at NVIDIA, it's over a $600 billion company. TSMC, over a $600 billion company. These companies deal with chips. We have JP Morgan, almost $500 billion company. It's a bank. Tesla is an automaker, but we have to remember that in 2016, they told NVIDIA, you're moving too slow for us, and they started to develop their own chip. So this makes them a chip maker. And during their battery day, they came out with the newest battery technology, which they're going to be using with their new vehicles coming out of Austin, Texas. These are the 4680s. So they're also a battery company. And then let's look at this. I want to show a clip of their FSD. Yes, Wall Street doesn't like looking at things that don't fall on the bottom line right away, but this is ultimately how you miss those growth stocks. I mean, just look how this is driving. First of all, it took in that red light way before I would have been able to see it. And just takes in everything on the sides. Look at that turn. It's unbelievable. Like, this is a brain at work. takes the biker and it's starting to decide what should it do, take him over, get into the left lane. Tries to go into the left lane, but sees a car coming, so quickly goes back into the right lane. Ultimately, it's working on getting into the left lane, waits until it can make a move, and then boom, goes into the left lane. And you can really go on YouTube and just watch thousands of hours of this. It just makes you know that they're way beyond just a typical car company. Now, Elon's talking about really focusing on Optimus Robot, and that is one of the most important products that Tesla is innovating on right now. And think of it, after looking at the FSD video, what is a robot? A robot is something that can see and act upon what it sees and what it's told to do. And this is exactly what the car is doing. It's seeing and it's going to a specific destination where it's told to go based on its vision. And this is the robot that they're going to be coming out with. So right now we see the robot that's in the hardware of a car. However, the next step is a robot in what we know and being that can actually do things in the real world. So you're not just investing in an auto company. You're investing in the innovator of our time and technology company really at its infancy of growth.
But, when you buy something like Tesla, I mean, Tesla's worth more than all the other automobile companies combined, and then maybe double them. I forget where it is now. I kind of lost track.
Sure.
But, Elon Musk is a smart guy, but he ain't that smart. But meanwhile, he's selling. Look at how much stock Elon Musk has just sold. I mean, he's laughing all the way to the bank. Tesla can go to zero, and he's still a billionaire just based on what he sold. So, he's already taken his chips off the table. I mean, he's playing with the house's money.
This really annoys me, but also just shows me how much they don't know. The fact that he doesn't give credit to Elon, yes, being that smart. I mean, going back to the 90s, he wanted to create an electric vehicle company. And in between, in order to get that initial funding, he needed to create internet companies and co-found PayPal and sell that for $180 million. And then he's also creating the most advanced rocket company in the world and really creating technologies that have never been there before. So I wouldn't even put not smart and Elon in the same sentence. And secondly, the fact that he's looking at Elon selling, which we all know him selling had to do with, one, the tax bill that he has to pay, and also due to the blowback that he was getting that he never paid taxes. So really looking at this and just focusing on the point that he sold when right now he actually owns more shares than he owned before and owns hundreds of billions of dollars in that company shows that they pickpocket data that really has nothing to do. Anyway, I will not be investing in Daimler. I will stick to my Tesla investment. I am very confident in Tesla's execution and growth over the next decades, and I am happy to be a Tesla investor. Thank you so much for watching this video. I hope this was helpful. Please like and subscribe, and I will see you in the next video.